Hello and welcome to Earnings Echo. We put together the most important information about the trade desk.
Yeah, and today we are doing a deep dive into a pretty massive market disconnect for you all.
Right. Imagine a highly profitable working factory, right? But management decides to briefly halt some lines to install a massive AI robotics system.
Yeah, in the market, it's panicking about the construction costs today, completely ignoring that the factory will soon run, you know, exponentially faster.
Exactly. That is exactly the dynamic we are seeing in this quarter's results. Let's just look at the hard facts first.
Sure. So they posted Q1 revenue of $689 million, which is a solid 12% year-over-year growth.
And earnings.
Non-GAAP EPS came in at 28 cents, and adjusted EBITDA hit $206 million, holding a really healthy 30% margin.
Okay, so stable double-digit growth.
Right, plus their Q2 guidance projects at least $750 million in revenue. So by any normal measure, a very healthy quarter.
Wow. But the market reacted by just shaving 15% off the stock in after-hours trading.
Yeah, dragging the price down to around $20.06.
Wait, a 15% haircut. A 12% top-line expansion and solid forward guidance do not naturally trigger that kind of sell-off. I mean, why the aggressive move?
Well, operationally, the core business is rock solid. Customer retention is sitting comfortably over 95%.
Which is a trend they've held for a decade, right?
Exactly. Plus, connected TV now drives over half their total revenue. And audio, while it's currently only 6% of the business, is actually their fastest growing channel.
Okay, so the panic isn't about revenue at all.
No, the market is hyper-focused on the cost structure right now.
Okay, let's unpack that cost structure then. Because looking at the numbers, operating expenses are expanding noticeably faster than the top line.
Yeah, they really are.
The massive red flag for me is platform operations. It spiked 27% year over year.
Up to nearly $182 million, yeah.
Wait, really? A 27% jump in operations costs just to keep the platform running? Where exactly is all that cash vanishing to?
It's going directly into scaling their AI capabilities. Management confirmed heavy, immediate investments in hosting capacity and data infrastructure.
Oh, right. Because to understand why they are spending so much, you really have to look at the underlying mechanism.
Exactly. They are processing millions of ad opportunities per second.
Yeah, their Koa AI isn't just some basic algorithm. It's an engine making millions of split-second bidding decisions across the internet simultaneously.
Right, and scaling that up requires a ton of upfront capital. To do that without lagging, they literally have to build and lease massive localized data hubs.
I see. And given those heavy AI costs squeezing the margins, I mean, you'd think management would be sweating.
You would think so, but on the earnings call, they sounded entirely unfazed. They reiterated their focus on capturing a $1 trillion total addressable market.
Wow, $1 trillion. Did they mention the macro headwinds at all, like geopolitical uncertainty and the industry tariffs?
They did acknowledge them, yes, but they remain completely confident in the long-term shift toward open internet advertising.
Okay, which brings us back to the stock price. If you are listening to this and wondering how bad the market's panic really is, let's look at a reverse discounted cash flow valuation.
Right, and if you aren't familiar, a reverse DCF is really just a mathematical party trick we use to figure out exactly what future the current stock price is predicting.
Exactly. So let's run the math on that $20.06 post-drop valuation. What does it show?
Based on that price, and a baseline 2025 non-GAAP net income of about $871 million, it yields an implied negative 2.1% compound annual growth rate over the next 10 years.
Wait, negative 2.1%. Investors are literally pricing in a shrinking business.
Yes, a scenario where net income shrinks from $871 million down to $702 million.
The market essentially looked at a company growing at 12% a year and said, well, this business is clearly dying.
Yeah, it's a historic level of pessimism.
Even if revenue growth permanently slowed down, stable margins would still produce net income growth, not a contraction.
Right. And if we evaluate this on an alternative GAAP net income basis of $443 million, the implied growth rate sits at just 6.9%.
Which is a highly achievable hurdle for a market leader. So what is the structural thesis for their long-term growth?
It relies heavily on their strict objectivity. Unlike the walled gardens, the trade desk does not own media inventory.
Meaning they have zero conflicting incentives when buying ads for clients.
Exactly. When you combine that trusted, objective stance with their Koa AI automating complex media buying, you have a compounding structural advantage.
So here is the final echo for you, the investor. The stock is currently priced for structural decline.
Right, meaning any margin expansion once these AI infrastructure investments level off could generate significant upside.
Or any top-line reacceleration, really.
Yeah, we really have to ask if investors are mispricing a temporary upgrade for a permanent decline.
It totally makes you wonder. I mean, if the trade desk is spending $182 million in a single quarter just to keep up with AI data demands, what happens to the smaller ad tech players who don't have that kind of cash lying around to upgrade their servers?
Oh, that's a great point.
Are we about to see a massive wave of industry consolidation? Definitely something to keep an eye on. And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.